Hi everyone and welcome. You want to increase your passive income? Or perhaps you're an income investor? Well, today we go through 5 high quality, undervalued dividend stocks. To start off with a quick refresher that the dividend is one of the methods that a company can distribute its earnings to its owners. And perhaps in Peter Lynch parlance, the slow grower is generally the best dividend stock. So it's a company that's very established and perhaps they're not going to grow massively in terms of revenue, but they're able to provide a very healthy and stable dividend. And just so you know, on this channel, we look at investing and a touch of personal finance as well. So what does good look like for dividend stocks? Very importantly is that predictability and consistency. If you're having sort of 3, 4, 5, 6% a year, you want to know that you can rely on that coming in year after year to bring some cash into your account. So a company that perhaps cuts its dividends regularly or varies it substantially isn't necessarily the best choice. I think kind of a 3 to 7% is a really good dividend yield, and the dividend yield is comparing the dividend value to the share price. So if the share price was $1 and the dividend yield was 4%, that is then a 4 cents dividend per share. We also want to have a look at the payout ratio to make sure that the company can afford to pay out the dividend that it is planning to. I think good also looks like low debt, because one of the worst things to do is some companies artificially want to keep their good dividend record going, and they actually pay the dividend out of debt sometimes. And I think that is not sustainable in the long run. For really, really good dividend stocks, you actually want there to be an element of capital growth. So not just chipping in your 4, 5, 6% a year, but if the actual share price of the company is undervalued as well, that can really turbo boost your returns. So the criteria for my 5 cheap dividend stocks, which we'll go through shortly, is first of all a yield around about 4% or higher. Secondly, it must be a company that I've looked into. Whether or not I own it or perhaps I've researched, it has to be something that I've done research on. The payout ratio must be under 100%. The debt to equity must be 1 or below. And that's the criteria that I've used to pull this list together. So here we go, top 5 cheap dividend stocks. Here we go, number 5, Direct Line Insurance Group. I'm a very happy customer of theirs, very consistent company, and we've got some good ticks in the box here. So first of all, it looks a little bit undervalued here, so you've got some capital growth potential. There's some nice sort of moderate annual earnings growth coming up. Excellent debt position, balance sheet looks good, and look at that juicy dividend, so it's an excellent yield. Now there is a very high payout ratio now and in the future, so what we're saying here is this is number 5 because you probably capped out roughly at where we are. You want just something that ticks over in your portfolio, this is a good place to start at number 5. Here we go, a bit controversial here. Number 4, British American Tobacco, a much larger company, big market cap, over £60 billion. Now this one, again, looks undervalued on capital. Look at that PE ratio, very cheap indeed. Forward yield, over 7%. Now, the earnings per share are forecast to increase from 280, you can see there, touch to 340, which means that the payout ratio should improve. And we can see here, payout ratio is all right at the moment, but it does improve. So there's definitely room to grow that dividend per share. Debt position's all right. There's quite a lot of debt on the balance sheet, but in terms of debt to equity ratio, it is below 1. And I think you can say with this company that it's pretty consistent. There's not going to be any particular surprises, and the dividend should keep pouring in. And that book value per share look is roughly equal to the share price, getting towards £28. So again, it certainly doesn't look overvalued. That's a good one at number 4. Right, next up, Walgreens. So Walgreens, the dividend is a bit lower than the previous two we've seen, so it's at 4%. If you look at this payout ratio, future growth of the company, payout ratio in the future, 37%, which suggests significant room to grow the dividend in the future. There's also some potentially significant capital growth if you believe the stats here. And that forward PE ratio looks absolutely stunning. Debt to equity is all right, which is why it's not higher up the list. There's quite a lot of debt, although it's very long-term debt. And there's really nice forecast earnings growth in the next handful of years. Walgreens is number 3 on the list. Now we're back to the UK for number 2, and this is Aviva. Now Aviva's been transforming its business, and what it's been doing is kind of focusing on core markets, UK, Ireland, and Canada. Now the business was much larger and covered a bigger geographical area, but they have been shedding and selling off those business areas. And what they should do is really allow them to, with the digital journey as well, substantially reduce their costs. I have a look at these guys, their book value per share, and since 2012, that's been kind of growing up bit by bit every year. And we're now getting towards £5 book value per share. Share price is about £4. So straight away, even though the company's been on a really nice run recently, it looks undervalued on the capital front. Now that trailing PE is just 6, really cheap, and the dividend yield there going forward is 5%. If we have a look at this payout ratio, look how low that is at the moment, 27%, based on the recent earnings per share figures. And because of all the changes in their business, there is going to be some bonus returns to shareholder probably coming up in the next year. So you're not just getting your 5% with room to grow, but you're going to get some of these additional short-term special dividends. So Aviva there is number 2 on the list. Right, this is the one you've been waiting for. We are with Unum Group as number 1. Unum Group's got all the right indicators for a really strong long-term dividend stock. Now, first of all, it has been on a run, but there's been a little bit of a drop-off recently. And if we look at the stats, that forward P5 trailing 7, that is absolutely excellent. You've got a really cheap company, barely at half its book value. Looks like lots of capital growth potential. Earnings forecast to grow very nicely in the coming years. Debt level is relatively low in terms of debt to equity. You look at that balance sheet, there's very little debt compared to the assets on the balance sheet. And the dividend is comfortably over 4%. But the beautiful thing here is look at that 30% payout ratio. And the future payout ratio is just 24%. And historically, that payout ratio has never been above 50%, about 45% in the last 10 years. This company has got a really long runway for growing their dividend on a year-by-year basis. And they're also buying back shares. Look at that absolute reduction in shares there. So as a shareholder here, you've got dividend growth, you've probably got capital growth, you've got number of shares reducing. This is the perfect cocktail of a fantastic long-term compounder. And that's why Unum Group is number 1. If you want to see how Unum Group fits into my portfolio, click the box set here on the screen, and that will take you through to my portfolio reviews.